Welcome to The Explainer. Today, we're diving into a really powerful financing tool that's built just for real estate investors. It's called the DSCR loan. So if you've ever felt like your bank just doesn't get your business model, well, this one's for you.
You know, for so many investors, this question right here hits on a huge source of frustration. I mean, you've built a portfolio, you have assets that are making money every month, but the second you walk into a bank for a loan, what happens? They immediately want to see your personal tax returns and your pay stubs. It's a huge pain point.
And this slide just lays it all out, right? On one side, you've got your traditional loans, and they are all about your personal income. They want your W-2s, your tax returns, the whole shebang. But an investor loan, like a DSCR loan, it flips the script. The focus shifts completely to the property's cash flow. It's built to handle things like LLCs, which, that alone removes a massive roadblock for most serious investors.
So just imagine this for a second. What if the loan application was all about the asset itself? What if the only thing that mattered was the property's ability to make money? Well, this is where this different kind of loan really changes the game. It's like a much-needed off-ramp for those really difficult traditional loan processes.
In this quote, it absolutely nails the core idea. A DSCR loan is basically a business loan for your property. The lender's main concern isn't what your personal paycheck looks like, it's whether the property can pay its own bills. It's a huge shift in thinking, away from you the person, and onto the asset as its own little business.
Okay, so let's get into the magic number that makes this whole thing work. It's called the Debt Service Coverage Ratio, or, as you'll always hear it, DSCR. This is pretty much the most important metric for this entire type of loan.
And the formula itself is actually pretty simple. You just take the gross monthly rent, that's all the rent you collect, and you divide it by the total monthly costs for the property. People in the biz call this PITIA. That stands for principal, interest, taxes, insurance, and any association or HOA fees. This one little number tells a lender almost everything they need to know about how healthy that investment is.
So you get this number. What does it actually mean when you're applying for a loan? Well, if your DSCR is less than 1.0, that's going to be a red flag. It means the rent coming in isn't even enough to cover the monthly bills. The property is losing money, and for a lender, that's a deal breaker.
Now, if you do the math and your DSCR comes out to exactly 1.0, that means the property is breaking even. Every dollar of rent that comes in is going right back out to cover the costs. This is often the bare minimum you need to qualify. You're not making a profit, sure, but hey, you're in the game.
And right here, this is the sweet spot. A DSCR over 1.0 means the property is generating positive cash flow. It's profitable every single month. The higher this number goes, say a 1.25 or a 1.5, the better that investment looks. It makes you a way more attractive borrower and just paves the way for a nice, smooth approval.
All right, so the whole concept makes sense, right? The property basically pays for itself. But what about the person behind the property? Now that we get how it works, let's talk about what's required from both you, the investor, and the property itself. Okay, first up, you, the investor. While your W-2 isn't the star of the show, your personal financial responsibility absolutely is. Lenders are going to want to see a credit score of at least 680, and they'll want to see that you have enough cash, liquid assets to cover at least 3 months of the property's payments. And here's a really key detail. Even if you hold the property in an LLC, they're going to check your personal credit. You're the personal guarantor, which just means you're personally backing the loan if the business can't pay.
Your experience level also plays a really big role here. If you're an experienced investor, and that usually just means you've owned an investment property for over a year, you can get bigger loans and better terms. We're talking a higher loan-to-value, or LTV, which means you can borrow more against the property's worth. Now, you can still get these loans if you're inexperienced, but the terms will probably be a little more on the conservative side.
Now, let's talk about the property itself. It's got to be a standard residential investment, so think single-family homes, condos, or those small multifamily buildings with up to 4 units. The big one here is that it must be a non-owner-occupied rental. You can't live in it. This loan also has to be the first and only mortgage on the property. And finally, you can't have it listed for sale. Lenders want to see that it's a stable, long-term investment.
So how does this all actually happen? Well, the process is really built for speed. It usually starts with a quick online quote that uses a soft credit pull so it won't ding your score. Then you'll upload some key documents, like the lease agreement, to prove that rental income. After that, underwriting does a hard credit pull and gets the property appraised. You'll get a final offer, and if it all looks good, you can close and get your money in as little as 5 business days. It's fast.
So let's boil it all down. Why does this matter to you? Because the DSCR loan is a tool that was literally built for how real estate investors work today. It lets you qualify based on the strength of your investment, not your day job. It's perfect for LLC ownership, it cuts way down on all that personal paperwork, and it gives you access to some serious capital so you can grow your portfolio.
And you know, this is really the ultimate question, isn't it? It completely shifts how you think about things. It's no longer, can I afford this loan? It's, can my investment afford this loan? It's just a really powerful way to think about leveraging your assets and truly scaling your real estate business. Thanks for joining us on The Explainer.